Cloudflare beat consensus on both the top and bottom lines for Q2 2026.
Yeah, they really did.
I mean, revenue came in at $696.1 million, which is a 36% year-over-year increase.
Right, and that comfortably beat the $665 million estimate.
Exactly. And adjusted EPS was 29 cents, edging past the 27-cent estimate.
The guidance was incredibly strong, too.
It was. For Q3, revenues projected at, let's see, $736 million to $737 million, with 34 cents in EPS.
And they raised full-year 2026 revenue guidance to that $2.864 billion to $2.870 billion range.
Yeah, with EPS raised to between 1.25 and 1.26, the market absolutely loved this print.
Oh, for sure. Shares popped over 17% in after-hours trading.
Surging past $330 and breaking right through its previous 52-week high of 305.
But, we really need to look at what's going on under the hood here.
Right, because beneath these super clean adjusted beats lies a massive GAAP net loss of $170 million.
Which is about 48 cents per share.
Exactly. So that is what we are focusing on today. We're doing a deep dive into why that massive loss occurred and what it means for anyone holding the stock.
Because that stark divergence between the non-GAAP beat and the GAAP loss, it really tells the story of what management is actually doing right now.
Okay, let's unpack this. Because, a GAAP loss driven by a $150.7 million restructuring charge in Q2 is jarring.
It's a huge number.
Cloudflare is cutting approximately 20% of its workforce. Total restructuring charges for the year are expected to hit up to $165 million.
And about $130 million of that is going to be paid out in pure cash.
Right. And CEO Matthew Prince is calling this Strategy Act 4, which he describes as a fundamental shift to an agentic AI-first operating model.
Yeah.
But taking an axe to a fifth of your staff during a period of 36% revenue growth, I mean, that's like rebuilding the plane's engine while it's in a steep climb.
It is incredibly aggressive.
So I have to push back here. Is this a genuine strategic pivot to AI? Or is this just, I don't know, a heavy-handed way to appease Wall Street's demand for efficiency?
Well, that's a fair question, but you really have to look at the capital reallocation. What's fascinating here is that management is aggressively reallocating resources away from older models.
So they aren't just cutting cost to look profitable on paper.
No, not at all. They're literally building the physical infrastructure for AI agents to operate. They're dismantling legacy teams that supported older operational models to fund this new AI infrastructure layer.
Got it. Which I guess justifies that short-term margin hit and the massive restructuring charge.
Exactly. It's the brutal mechanics of transitioning the business.
Having established why they are pivoting so hard to AI, we really should examine if this pivot is actually showing up in the network's underlying usage metrics.
And it absolutely is.
Here's where it gets really interesting. For the first time ever, over 50% of the traffic on Cloudflare's network is now non-human, machine-to-machine traffic.
Which is just a mind-blowing statistic.
It's a total paradigm shift. I mean, Cloudflare isn't just serving websites to humans anymore. They are serving as the highways for autonomous AI agents.
And developers are flocking to this highway.
Yeah, their Workers developer platform added nearly 2 million new developers in Q2 alone.
Oh, wow.
Right. That surpasses the 1.5 million they added in all of last year. So total developers now sit at 7.4 million.
Those developer numbers are staggering, but you really have to connect that to the margin profile to see the whole picture.
Right, because the non-GAAP gross margin came in at 73.1%.
Which is actually down 320 basis points year over year.
Because heavy AI traffic dragged it down, right?
Exactly. AI inference is computationally heavy, and that changes their traffic mix, driving up infrastructure costs. But, and this is key, it actually ticked up 30 basis points sequentially.
Wait, really?
Yeah, it is the first sequential gain in gross margin in 8 quarters.
Oh, wow. So that sequential uptick essentially proves that they are beginning to optimize and efficiently monetize this massive influx of machine traffic.
Exactly. They're figuring out how to manage the unit economics of this heavy AI workload.
Okay, so the developer adoption is off the charts and margins are stabilizing. But how exactly is Cloudflare converting that into actual enterprise revenue?
Well, they added 282 large customers, which they define as customers spending over $100,000 annually.
Bringing the total to 4,698, which is a 27% year-over-year increase.
And those large customers now make up 73% of total revenue.
That's huge. Plus, their dollar-based net retention rate, or NRR, improved to 120%.
Yeah, up 200 basis points sequentially and 600 basis points year over year.
But the mechanism driving that expansion is changing, right? CFO Thomas Seifert noted a major shift in their billing model
He did. They're moving away from those flat rate, ratable SaaS contracts.
and moving toward consumption-based, pool of funds or t-shirt size pricing structures.
Right, which completely changes how Wall Street models their cash flow.
I have to push back on this billing shift, though. If they are moving away from predictable SaaS subscriptions to consumption models, doesn't that make revenues incredibly lumpy and unpredictable from quarter to quarter?
It does. And Seifert specifically warned about that quarter-to-quarter variability on the call.
So why do it? Why risk that predictability?
Because AI workloads are inherently highly variable. A pool of funds model removes the friction for enterprise adoption.
So it's basically like a prepaid debit card for compute power.
That's the perfect way to look at it. It allows customers to scale up instantly without renegotiating a contract. And that frictionless scaling is what ultimately drives that impressive 120% net retention rate.
That makes total sense. So since the underlying business is accelerating, let's look at how management is spending its cash and setting expectations for the stock's future.
And they are sitting on a mountain of liquidity.
Yeah, they ended the quarter with $4.16 billion in cash and available for sale securities.
But they also hold significant debt.
Right. They have $1.29 billion in current and $1.97 billion in non-current 0% convertible senior notes.
Which introduces some serious dilution risk if those notes convert to equity.
For sure. But despite the leverage, they are still doing M&A. They just acquired Void Zero for $164.2 million.
And $143 million of that was classified as goodwill.
Which just shows they are paying a massive premium to advance this AI strategy, following previous buys like Replicate and Kavera.
Right. And alongside all this, they raised their long-term targets.
Yeah, their operating margin target increased to 30% plus from 20%.
And free cash flow margin target went up to 30 to 35% from 25.
They also set a Rule of 50 target for 2027 and beyond and stated they are pacing ahead of their goal to reach GAAP profitability by 2028.
But you have to weigh all that against the risks.
Definitely. The stock trades at a massive premium, around 48 times sales.
Yeah, meaning any future miss could be heavily punished.
Plus, director Carl Ledbetter recently sold $1.41 million in company stock. So what does this all mean? With the stock priced for absolute perfection, are these aggressive new Rule of 50 targets achievable? Or is the market getting ahead of itself here?
Well, when you synthesize the balance sheet, yes, the convertible debt load is heavy.
Very heavy.
But look at the cash generation. They had $56.4 million in free cash flow this quarter, which is 8% of revenue.
Right.
And those smart tactical acquisitions like Void Zero show a company aggressively buying its way into the AI infrastructure layer.
While promising GAAP profitability by 2028.
Exactly. So the premium valuation is basically the price of admission for this level of structural growth.
It's a high-stakes pivot,
Mm-hmm.
but they seem to be executing it well.
They do.
Before we wrap up, I want to leave you with a fascinating nugget that we haven't deeply discussed yet.
Oh, the payment rails.
Yes. During the call, CEO Matthew Prince briefly mentioned something called Cloudflare.pay.
Which is just a wild concept to think about.
It really is. Think back to that stat earlier. Over 50% of the internet is now machine-to-machine traffic.
Right.
If Cloudflare is building the highways for these AI agents, they aren't just securing the traffic, they are positioning themselves to build the actual payment rails for AI agents to transact with one another.
Yeah, it completely changes how you view their long-term potential.
Exactly. So let that sink in. What does an autonomous machine-to-machine economy actually look like, and who controls the toll booths?
It's a massive question to ponder.
It definitely is. Well, if you found this deep dive valuable, make sure to follow the show for your daily dose of crisp, no-nonsense earnings coverage.